Hello, Alexei. Can you hear me?
Yeah, I can hear you.
Great. Good evening. How are you doing?
Great, great. Really like hoping it will like
Excited about the workshop.
yeah, yeah.
Awesome, awesome. Okay, so it's already 6 p.m. Central European time, which means that we can now start. I'm sure that more people will be joining, but anyway, let's stick to the timing. So good evening, everyone. You're very welcome at XFounders. We're very happy to see you. It's basically our first online event after the offline bootcamp that we held just 1 month ago in September in Turkey. So for those who are new to XFounders, let me just tell you a few words about us. So let me very briefly share my screen now. Okay, yeah, great. So guys, once again, for those who are new to our ecosystem, XFounders is a community-driven school for early-stage Web3 startups. And just on the 1st of October, we finished our first 1-month-long bootcamp that we organized in Antalya. So it was an amazing 4-week experience where we had 21 startups living together, learning, sharing experience, having mentoring sessions with our amazing experts. There were more than 40 of them coming literally every day to visit us and to share their expertise. So we then ended with a demo day with more than 30 investors present. And so after that, we were thinking like, how do we actually want to continue? Because we have such a strong community, such an amazing network that we really want to continue, even like do something before our next offline experience that we plan to organize in spring, in April. So we came up with this online format that we launched just a week ago. This is called XFounders Fundraising School, and we are now welcoming other early stage founders who want to join us here. So XFounders Fundraising School basically consists of 2 main pillars. That's pitch training that we organize for startups. The aim of it is to have a chance to participate in the pitch hour, which means pitching in front of top tier VCs, venture arms of large brands in Web3 and Web2, get a lot of feedback and have finally warm introductions and contacts with investors and continue dialogue with them. To that end, we prepared a special track where we get you ready for the speech hour. So this is something that we do inside of our online school. Another important element of it is our community. So this is basically a network of founders, experts, mentors, and investors who are there for you every day, ready to answer any questions, provide mentoring, support, a lot of materials, a lot of useful recommendations. And so this is all available, like just contact us. We are offering a special price for the access to XFounders Fundraising School. Only in October, it is only $1,000 instead of $1,500 that we plan to sell it for in November. So you still have a couple of weeks to get access to XFounders Fundraising School at this special price. And so, as I was mentioning, one of the core elements of XFounders community are online events. And this is basically the first one that we have gathered here today for. And I'm actually very happy to present you Alexei Karinuk, hedge fund investment analyst, educator, and founder of Giants Tokenomics company. Alexei, thank you very much for joining. I know that it's going to be a very exciting experience for you today. And like during the bootcamp, we understood that tokenomics is absolutely a burning topic, a burning issue for any native like Web3 founder. So please share with us what you have prepared today. And good luck.
Thank you very much, Aliona. Can you hear me? Everything's fine?
Yeah, all good.
Yeah. So today I'm going to talk about tokenomics for startups. I won't go too much into detail, so this will be a kind of introductory lecture, but still I will cover the main issues that will help you to further fundraise, to communicate with your community, and to deliver your startup. But before I start, I would like to say much thanks to XFounders team that invited me this workshop. It's a pleasure to work with XFounders. So let's start. But before I do it, just a few words about myself. I'm a founder of Giants Tokenomics company. We are a remote team of 6 tokenomists and tokenomics engineers with over 30 projects delivered in DeFi, GameFi, infrastructure, social fi, and SpotFi. Besides, I'm a tokenomics lecturer and a tokenomics enthusiast. I kind of work at the blockchain department at Fixed Tech University. Before, I was a founder of FinModel BZ, and this was a financial modeling agency that delivered over 30 projects to seed to corporate level startups in Web2. I also hold a degree in international finance, and this really helps me a lot with this tokenomic science. And I'm based in Tbilisi, so if you are here, let's meet offline. I'm very open. And here is my logo. So today's plan is as simple as that. First of all, we'll talk about the tokenomics definition and rationale. When I was a student, I didn't care much about any definitions at all. But then when I made my own practice, I understood that every word makes some sense. So you should define first the tokenomics to understand what is it about, and then do some job on it. And also rationale. Why now? Why is it important? Then utility and supply model. First utility, because startups usually forget about it, and only then the supply models. And then I will talk a little bit. This will be a helicopter view on the deliverables to stakeholders, because it could be a topic for another lecture. You're highly welcome to ask the questions. Alona will pass them to me, and I will try to answer at the end of this lecture. And we've got a total time of 60 minutes, and so I should be in a hurry, so let's start. So what is tokenomics? First of all, I would like to talk a little bit about the foundation of this science. There are different kinds of Web3 primitives. Automated market maker, proof of stake, proof of work. I'm sure you have heard something about this, and this is not what our lecture is all about. So there are kind of Web3 primitives. But tokenomics is all about bringing economic primitives to this Web3 space. What kind of primitives? Microeconomics, users utility function. Macroeconomics, aggregated supply, aggregated demand. Behavioral economics, game theory. Computational economics, especially when you deal with engineering stuff, Python and so on. So as an example, agent-based modeling. Corporate finance. If you want to deliver investors to speak the same language with them, you need to learn some basics of corporate finance, such as financial modeling, valuation, and this kind of stuff. And of course, when we deal with pumping, dumping, and so on, so you need to know the basics of economic sociology and psychology. So we see the intersection of economic primitives and Web3 primitives, and we see the crypto economics and tokenomics. So tokenomics is inside of crypto economics. I define the difference as if you have the native token, then it's tokenomics. If you don't, then it's a native token, because the modeling, the approach is completely different when you have this token. As an example, if we are a Ton, a Telegram Open Network team, and we try to build the tokenomics, then it's tokenomics. When we build some project on top of Ton, and we don't have our native token, but we accept payments in Ton, for example, then it's crypto economics, and we have a different approach towards that. So our goal as tokenomists is to build sustainable economies. It's not pumping and dumping as I see it. Yeah, it's about building sustainable economies. And what does it imply? It implies that we should we can control token demand and supply. We can affect them, because users, counterparties have their own motives, and they're free to do whatever they want. So we can affect their actions. That's one thing. In a way that equilibrium, token price and volume. So we have some kind of equilibrium here, which is price and volume are beneficial to stakeholders, which means that like the protocol, the startup is not beneficial to stakeholders, they're gonna leave. And if we are interested in these stakeholders, then probably we should do something to incentivize their behavior. Yeah. And then in the short and long run, John Maynard Keynes once told that in the long run, we are all dead. So like we should always think about the tactics and the strategy. And if the token price goes down to zero, then like there is no sense in economic sustainability in the long run, because you should think about now as well. And we see some graphs here. So what do we see? The price and the volume. And here we see a demand curve. This is how many tokens somebody gonna buy for this or that price. So the higher the price, the lower the volume. And this is the supply curve. And here the opposite. How many tokens are going to deliver to the market given specific price. And on the intersection of supply and demand, we see some equilibrium. Yeah. And by the way, the logo of Giants is based on this supply and curve intersection. And our aim is to find this equilibrium. So this is all about. But then, which is most important, the situation changes every period. So this is a time-based system. And next period, we have another situation. Some tokens were invested, some people came into your startup, so the situation changed, which means that we have another price and another volume. And maybe in this period, everything was okay, the situation was beneficial to us, and next period is not at all. So you should think about short and long run here. Now, we should keep in mind the external factors and internal factors. And tokenomics is how we design supply and demand and get economic sustainability or insustainability, yeah? How it happens in most cases. So what are external factors? These are the factors that we cannot control. For example, what are the motives of stakeholders? Once again, we cannot control, we cannot manage stakeholders' behavior. These are investors, these are users, and so on. We can nudge them to behave in a certain way. And also, and I underline this, that they have financial and not financial motives. For example, gamers, yeah? They can simply like your game, and that's the reason they participate. They can lose much more tokens than they earn, but they love your game, they enjoy playing it, and that's okay for them. So both should be considered here. Then, what are the market inputs? As an example, if a Bitcoin price goes down to zero, then everybody will tell you that like, oh, it's a scam, crypto is a Ponzi scheme, so your token price will probably go down, like maybe not to zero, yeah, but 10%, 50%, and 70%, and so on. And this is the factor that we can control as well. And another factor, and this is also very important, marketing and product and marketing team inputs. We cannot control how many users are going to go into our startup. This is defined by the marketers, not us. We have these numbers and we put it in our schedules, in our model, and they decide how to deal with this external information, but we do not define it. Then we have these external factors, but there are internal factors. These are the factors that we manage. I will cover them later on, but like just a helicopter view here. We have a supply model. How do stakers get their tokens? Like they invite in friends and get their tokens, they become validators and get their tokens, and so on and so on and so on. Demand and utility models. I should put utility first, by the way, but here is the second one. Utility is really important. This is the most important part here. How do users use their tokens? They use tokens to pay for something. They stake tokens and get part of real yield. And like I will cover this as well, but this is really important. This is the most important part here. And also the flow scheme. How is the money is circulating inside your economic system? We've got like external money. This is fiat, stable coins, Ethereum, Bitcoin, and so on. So these are the money that you, again, do not control. but you use them to build your product. And you have your native token. As an example, once again, your users stake tokens, yeah? And you have treasury, and out of this treasury, some like USDT revenue goes to the staking pool, and those who stake receive part of the staking pool revenues. But you should build this flow. You should understand where it comes from. So building these flows is a part of this flow scheme. So these are the factors that we control as tokenomics. And then we get economic sustainability, as I hope that you get it, because most startups are unsustainable in terms of tokenomics. So what's the supply and demand ratios in the periods? Once again, we have different periods. You got like million tokens unvested next period, and you have one new user. So probably the situation will be a little bit worse next time, yeah? So you need to comply your supply with your demand here. What's the startup treasury state? Imagine your like 90% of your demand comes from buying out from the DEX. So, okay, the token price goes up, but all of a sudden you get rid of all of your cash and go bankrupt. That's not very good for you. So in order to be sustainable, your treasury should go up or at least be stable. And what's the native token price in the short and long run? Once again, tactics and strategy. Yeah. If the token price goes down to zero now, then there is no sense anymore. Nobody will go to a protocol, and you have to do some restart or like even invent some new startup. So a quick illustration of these external and internal factors, because this is the most important. You've got some external information from the marketing team. There will be 100 players in the game. And the marketing team tells you, invent something. And we invent 3 kinds of NFTs. The first NFT costs 20 native tokens. Second NFT costs 100 tokens. And third one costs 400 tokens. And also, we provide the information on the income and cost, a daily income and daily cost of the NFT. So this is 1 token, 3 tokens, 5 tokens. And as for the cost, like in step 1, for example, we have amortization, we have repayment. So daily cost of 0 tokens, 1 tokens, and 2 tokens. So in the case A, we have net income of 1 token per day. In case B, 2 tokens per day. And case C, 3 tokens per day. Then we pass it through back to the product team, marketing team, and they tell us the following information. The probability of buying this NFT is 90%, of this NFT 50%, and of this NFT 20%. So out of 100 players, 20 gonna play your game. Then we get another information that the average lifetime of an NFT holder, which means that how long they're gonna stay with us, is 2 months, 3 months, and 4 months. So the more they invest, the more interested they are. Everything is in our life. And based on these internal factors, the factors that we control, and external factors, they are in red, that we cannot control, we get some information. Then we define somehow the sustainability. For example, like we have no other information, and we define sustainability that the startup is sustainable when demand is higher than supply, and unsustainable when supply is higher than demand. Then let's look what happens. Let's take the second case, the big case. So out of 100 players, 50%, that is 50 players, buy NFTs. And they provide a demand of 5,000, like 50 multiplied by 100, and they provide a demand of 5,000 tokens. Then they face daily costs. Then 50 multiplied by 1 multiplied by 3 months, which is 90 days, is 4,500. And with the supply, 50 gamers have a daily income of 3 tokens multiplied by 90, and that is 19,500. So the supply is higher than demand. Then probably, if we exclude all other factors, the game won't be that sustainable. And here we see the same situation, and it's even worse. The supply is much higher than demand, and in this case, supply is lower than demand. So we probably think that the price of the token will go up. So why the hell the player should play this game? Maybe he or she just likes it. That's the reason. So it's okay if the product team tells us that it's okay for the players to play this game. So based on this incoming information, we build such a model. So why is it relevant? Just imagine how it was before. This is like a very common case, a Web2 loyalty case. Yeah, you've got a startup. Let's imagine it's a ticketing service, and we've got a user. A user makes some actions that are beneficial to a startup. Just an example: invites a friend, fills a form, increases the number of purchases. And for these beneficial actions, a user gets some points. And with these points, the user goes to a fully centralized ecosystem and buys some goods there. For example, on this fully centralized ecosystem, here the startup sells airplane tickets. And in this fully centralized ecosystem, a user can buy only tickets to museum. But the user wants to go to Rammstein, you know. But the problem is that the only opportunity a user has is to buy museum tickets. So that's one problem. Second problem is the startup fully redefines the points to goods rate, which means that today the price of one museum ticket to museum is 1,000 points. Next month 5,000, then 1 million, then 1 billion. And another problem I didn't state it here, but a user may have a wrong passport, and startup simply burns all of the points. That happens sometimes. So a startup controls user action, and user's only option is whether to participate or not. What happens in Web3? Again, we have a startup and a user. A user gets tokens for the actions that are beneficial to startup. But a user has other options here. Simply going to DEX and selling the tokens and getting some Bitcoins. The token price will go down, and another user won't be that incentivized to do some beneficial actions because the token price went down. Second option, a user sells all of the tokens, another user sells the tokens, many users sell all of their tokens, the token price fully collapses, but there is another user or investor who buys out all of the tokens, goes to startup, and cheaply buys their tickets to museum. And that is very harmful to the startup. But there is another problem, that a user can go to a decentralized ecosystem. On this decentralized ecosystem, a user sees like a competitor of this startup, and this competitor proposes buying tickets to Rammstein. User pays the whole price or part of the price with the token of the competing startup. So the competitor got a user, a motivated user that already provided the eagerness to buy something. And this startup lost the client, which is not very good. So a user can freely use the token, and startup can only nudge a user to take some actions. And this is very important. What's more important, that the matters got much worse and much more complex, because on this decentralized ecosystem, we have infrastructure providers that provide some solutions for the profit, sellers that provide goods for the profit, liquidity providers who provide tokens to the DEX and behave in their own way, and also financial infrastructure providers. What it means for us? It means the following. There are many interconnected parties that have their own egoistic or sometimes altruistic motives, and we cannot control them once again. So we cannot control parties' action. We should think of nudging them in the right direction. That's the most complex part. Also, what's also very important, that early errors in smart contracts have really huge consequences. So you should think twice, you should think 3, 4, 5 times before you start, because when you start, it will be very difficult to change anything. And token is a vital part of UX, backend, and communications. So if you tell everybody that there will be yield farming opportunity, and then all of a sudden this yield farming opportunity doesn't exist anymore, then probably the users that came due to this yield farming will leave your startup, and the token price will go down, and you're going to go bankrupt or face some other problems. So that is why tokenomics is relevant. Now, let's go to the practice a little bit. Before I cover the utility models, I would really like to recommend this brilliant piece of scientific research by Vasily Sumanov, Value Capturing Mechanism Theory. And he went really in depth with the topic of token utility because of it's of vital importance for you. You should understand what's the utility. So I strongly recommend to read this piece of paper. So there are like different utilities that you can put into your token, such as value transfer. I sent Bitcoin to my friend in Nigeria and paid gas fee for that. So no SWIFT, no banking, and so on, just paying the gas fee. Yeah. So it's a utility for the token. Second one, consensus and work. I stake Ethereum to earn rewards from the Ethereum protocol. Then dividend and cash flow. I own liquidity tokens and receive cash flows from this project. Discount. I own BNB tokens, which is Binance tokens, and get discounts at Binance exchange. Sometimes we can put several value accrual mechanisms together. For example, we can put discount and work mechanism. So you need to stake BNB tokens to get the discount, and that is different. They changed all the incentivization scheme for a user. Yeah. Then payment utility. I paid with a TON for TON DNS. Representation, collateral, or backing. Yeah. Like the most common case. I own DAI token that is backed by Ethereum or wrapped Bitcoin. Of course, USDT, USDC, all of the stuff is all about that. And this is a very popular narrative now. Later on, governance. I own LIDA token and can participate in LIDA DAO decision making. Once again, we can merge governance and dividends, and that will be a stock in the Web3 world. Fun tokens, hedonic utility. I own Unisocks and just have fun about this. Why not? And also access. I have a StepN Walker type NFT to earn JST. Of course, there are some other utilities, soulbound tokens, yeah, and there are many of them, but I try to cover the most common ones. Once again, before you build a startup, you should really deeply research this topic. Then, token supply models. The first one, I'm pretty much sure that you've heard of it millions of times. These are the tables, all this pie chart. So that's what most people call the tokenomics, but actually, it's a vesting model of the supply. That's it. I will receive X NIA tokens per month, which is basis, starting from the 6th month, which is cliff, and continuing for the next 36 months. And this is the vesting period. I can put it in such a way, yeah. But instead of putting from the 6th month, I can put when a startup reaches the level of 1,000 users. That is possible as well, with no conditional requirements. But there can be some requirements. For example, I work for a company and I'm going to be wasted for 36 months. But if I get fired in 12 months, then probably something going to change in this case. And there going to be some triggering event here. So I'm pretty much sure that you've heard of this model. Then proof of work, proof of stake, love drops, reward. This is all about you do something, you get something. Yeah, I will receive 6.25 Bitcoin in case I solve algorithm and add a new block to the blockchain. I invite a friend to the service and get some tokens for this. So I do something and get something. Then the most complex model, and I think this is the most promising, but you need some mathematical skills to go deeper into that. But I think that's really cool model. This is a bonding curve model. There is some mathematical formula that describes how we mint the token. And the price is like it's stated here, deterministic continuous price. So I can mint any amount of Onomy protocol NOM token at the Ethereum-based price, NOM supply divided by 1 million power 2, which means that if the total supply is 1 million, then the price will be 1 Ethereum. I really like this model because like you control the token price mint, and every next mint is more expensive than the previous one. So it's a very fair model because you always have to find motivation for users to mint these tokens. And if there is no utility for your token, then nobody will mint it. They will simply go to DEX. They see the prices are lower there. They will buy the prices there. And given you won't mint any more tokens, you won't receive revenue from this. So your treasury won't go up in this case. Also, a very common scheme, this is public sale, DEX supply. You simply put some tokens on the DEX, and that's the only way you can buy them. Or, for example, you can buy at a Binance Launchpad a Lazo Fan token for 1.6 USDT. And also airdrop. I will receive an Arbitrum token for being an eligible user of the Arbitrum platform. But here there are certain, like, you need to be eligible user, yeah? And here it's stated in this distribution specification that you need to score over 3 points. And there is a table there that states how these 3 points can be generated. So these are the utility and supply models and how they work. Don't be afraid of too much of this table, but that's of like vital importance that you understand that you should always comply supply and demand. So what we have there? Let's imagine like this is a marketplace. There are sellers and there are buyers. The only way to buy a good is to buy it with native tokens. So first of all, there is some unlock here. Team and investors unlock plus community unlock means total unlock, which is supply, yeah? 250 plus 500 is 750. And those who receive these tokens, they are free to do whatever they want. They can either sell them or hold them. And we like put some like there isn't like we think, okay, let's think that it's 50% of those who hodl, which hold, yeah, and 50% of those who sell. Then demand part. There are buyers at this marketplace who are gonna buy something, and they have an average check of 5, 5, 5, and then 10, 10, 10. Then we multiply the number of users, the average check, and this is the gross demand in tokens. 10 multiplied by 5 is 50, and so on, so on. So this is the gross demand, but this is not a demand. This is not a net demand, because the real demand is that we charge the marketplace fee of like, let's say 10%, yeah? And then out of this, and just imagine the sellers, they generate a revenue of, in this case, 2,500 tokens. They pay the marketplace fee of 250 tokens, and they can simply go to DEX and buy all of and sell all of their tokens, and the price will go down. So you shouldn't forget that this is not the demand. This is a huge mistake to think so. So the demand is this, and all of the rest is supply. So this is a supply, and part of the tokens that are generated by the sellers and goes to DEX is also supply. So 50% is hodled by all parties, which means that 50% goes to DEX. Now, as to the DEX, like I won't go too deep into details, but it's Uniswap based. But we have some initial pool state here, 10,000 tokens, $10,000, and the price is 1. Then 50% is hodled, so the same sum goes to DEX. People go to DEX, sell their tokens, and get dollars. So we see that the dollar pool becomes lower and lower and lower, and the same happens to the price. So this is the way you should think. And like it's tokenomics is not about this part. Yeah, with this table, cliff, wasting, that's it. Oh, we have tokenomics. That's not tokenomics. Tokenomics is when you comply like demand and supply. That's tokenomics. It shouldn't be that like complex, but like this table is enough, but still you need to think, at least think about this. So like, whoa, that was so fast actually. So I was really afraid we're in shortage of time, so I was so fast. But I will pass some words, pass it through to Alena, and then I will speak more about the deliverables.
Yeah, Alexia, thank you very much. I mean, it was not fast, like I would say, all very clear, all very well structured. Thank you very much. Guys, we're not done yet. We just thought that we could just make a very small break to have a pause, to drink some water. Yeah, Alexei, so I'm really impressed. Like, this is such a good structuring of tokenomic basics, let's say. So, and also I can see some very positive feedback in the comments on LinkedIn. In terms of the structure. Actually, I wanted to say that it's indeed great to have many different approaches to presenting such important stuff for a Web3 startup. So, for example, during the bootcamp, we had 3 experts in tokenomics, each of them presenting their own approach, and now you're presenting yours. And so I think we can disclose it now that you will have 2 more events for our XFounders community in the upcoming weeks, where we will be actually studying a particular case of a startup, right? So Alexei will be going into detail about the tokenomics model of a particular startup. And so this is basically what we're doing at XFounders. Let me just remind you one more time that we have a lot happening inside. Let me just share my screen once again now. Yeah, so basically, our community is an amazing platform to get all the important contacts of experts and mentors, have warm introductions to VCs, and participate in closed events such as this one, though we're doing it publicly today as an exception, just to show what it is like to be a member of XFounders Society and community. And also, we have a very special track that will prepare you for fundraising to basically pitch in front of top-tier VCs, business angels, and large Web2 and Web3 brands in live stream, and get a lot of feedback, comments, advisory, and support. So please join us. We have, once again, a special price just till the end of October. So it is the cost of your lifetime access to XFounders community, to the entire network of founders and investors that we have very warm connections with. And so once again, Alexei will be continuing with 2 more lectures in the upcoming weeks. So please join us to take part in them as well and have a chance for your project to be reviewed individually. So Alexei, I think it's time to make some conclusions probably.
Yeah, but before I do some conclusions, I will cover a little bit, just a helicopter view on the deliverables, because I guess it's of vital importance for you. I spent so much time thinking of how to present this information from a founder's point of view. So I divided like the deliverables based on your budget. So under 5,000K, under 15,000, and more than 50,000. Well, basically it's like here it's after seed, round A, and pre-seed. Let's do it this way. So and you see that like there are squares and there are colors. So like if it's in green, then it's under 5K. So we've got 6 different products inside tokenomics: research, concept, design, model, simulation, and docs. Inside the research, some competitor overview, how many users they have, their supply model, their demand model. Just the basics of it. Don't go too deep into details, but still there should be some overview of it. Then market mapping. You probably heard of Samsung methodology. So what's your serviceable market? What's your probable share of this market? Based on this, how many users you're gonna have? So this is a top-down approach to the market. Then statistical research of your competitors. You can go to June Analytics, see what happens, in a way understand their churn rate, their retention, the lifetime of their users, how many users they have, how these users behave towards all the incentives. And alpha beta testing or testnet, of course, you have to like create something to test something. That's why it's in red. Then the concept, text description of utility and supply. Yeah, of course, you shouldn't have all the parameters, all the numbers, especially on the utility, because you can do it later on. But like text description is of vital importance. Then more detailed tokenomics description. I cannot say what's detailed, what's not detailed, but like you should be precise here. More numbers, more parameters, more schemes. And the best example of course, Bitcoin like style white paper, like only no pictures, very like much mathematics and so on. So this is the best way to present your concept. If you have like Bitcoin style white paper, you don't need anything else as far as I can see. So then design for me, it's the most difficult part because it needs some creativity. Please don't do this copycat. Unless it's just a business, I don't know, ticketing service, I need to introduce some loyalty scheme, that's okay. But like, please try to invent something. That's of vital importance. So token utility canvas, you can Google it, but like that's about the stakeholders, what stakeholders they have, what's their motives, what's the desired behavior, what's undesired behavior, and money flow scheme, how the money goes from treasury to liquidity pool to staking pool and so on and so on. So how the money is going inside your economic system. Then model, of course, the vesting schedule. How can we forget about this? But also, please, you have this vesting, but like next line, you can put the forecast of users so the potential investors can see that you at least think about like how the users comply to your vesting. If you unvest 1 million tokens, then and you have one user, there can be some question arise, and you should like then provide some information whether you're gonna buy out the tokens or you make some agreement, negotiate it, the further locking of your tokens, but like forecast should comply with the vesting. And of course, when you go like to a case of 15K, then you need some complex spreadsheet model. Then simulation. If it's GameFi, of course, you need machination soft. Please Google it. And if not, GameFi, infrastructure, SocialFi, then machination is for higher budget. Also, Python-based simulation modeling is also very important. When you like, if it's a big story, then you need some simulation, some reports on tokenomics, and also the tokenomics audit. And as to the docs part, charts of token distribution, 3-4 slide or docs page on tokenomics. Then you should provide the deliverables to the marketing team. So they put these deliverables into their materials and the product team. And what's more important, you should deliver your results to developers, because developers are not complex with the spreadsheets. They don't know how to deal with it. So you should give all the numbers. What's the NFT price? What's the number of points you need to get some kind of like to get a token and so on. So you need to provide them with all the formulas, so they should implement them in the smart contracts and make the startup work. So this is like a helicopter overview. Frankly speaking, it's a topic for another several lectures. But for now, I think you should like keep in mind, but that there can be like this or that kind of deliverables, and you should like model them, or you can simply write me. I can provide you with some deliverables on this. So this is all on this topic. Now to Q&A section, and also have a QR, so you can scan it and write to me in Telegram. And also I will be happy to answer some of your questions if you're gonna have some.
Alexei, thank you very much. Indeed, we do. We have at least one question that I just saw on LinkedIn. So let me just read it out loud. Give me a second. Okay, yeah, so we have a question from Yegor. So he's asking, should these external, internal, sustainable, and tokenomics illustration slides, I think he's referring to the ones you had at the very beginning, be a part of the white paper or light paper based on your experience and recent pitch trends you're observing? Is this the exact format how VC funds prefer it displayed in white paper or light paper, or are you seeing other ways to present it too?
Well, usually the external factors are just kept in mind, but like, okay, this external factor, this should be a part of token utility canvas, yeah? Which stakeholders you have, and what are their potential motives, and what's the desired undesired behavior. Market inputs just kept in mind, it shouldn't be put anywhere. Well, probably in the slide that tells that, well, crypto is growing, let's invest, that's it. Then marketing product team, of course, the inputs from the marketing team should be put in the spreadsheet, modeling, it should be put into all the modeling stuff. So and of course, some of it should be put into the slides. So external factors are important and they should be in the deliverables, but not there, sometimes not directly, but indirectly. Internal factors, all of them, the very precise description of the supply model, description of demand model, flow scheme, like in this way. Sorry. So this well, actually, I could provide you with some link later on, but it's not open at the moment. But you should show it. And then supply demand ratios. Yeah, it's part of the modeling. Startup treasury rate. Yeah, it's part of the modeling as well. So you should provide this at least if you are you have a budget of over 5,000 for that. So if you are raising like 3,000K, 300,000K, okay, you don't need this. But if it's like 5 million, then of course you should provide this information to investors. So everything depends on the scale. And token price predictions, well, this is more complex than probably for the budgets under 15,000K.
All right. Yeah, I hope that was extensive enough. We'll see what Igor answers in the comments. Alexei, we actually have another one. Alar is writing, I want to know more about modeling and how to do it if the number of users, so the source of demand, is an external factor. Is it correct to simulate several different scenarios with different inputs? For example, 5, 10, 100, 1,000 users.
Yeah, of course, this is the part of both modeling and simulation. So given this is the external factor that you cannot control, you should simulate different scenarios to see what happens. Yeah, of course, for sure. And also, the execution is the most crucial part, because you never know what happens. Usually a startup comes and the founder tells us, well, we're going to start in 2 months, but I know for sure they won't start in 1 year. So yeah, you should keep this in mind and put this into both modeling and simulation.
Okay, I hope this is clear. So guys, once again, Alexei will be speaking more for the members of a community and going much deeper into detail about all those models. Yeah, so actually I was going to say that, especially now in the current market conditions, I think it's just crucial to have a very clearly stated, a very well-designed tokenomics model. because a lot of investors are indeed like refusing to invest in tokens, preferring equity. So if you have plans to launch a token, you definitely need to be very, very careful and very well prepared. Yeah. So I'll say, do you want to show something more? Yeah.
Yeah, this is a site. I will send you the link, Tokenomics DAO, and this is the example of flow scheme. Just how this is the borrower, the lender, how they communicate with the protocol. In this case, is like Maple DAO, and here are like numerous examples of these designs. So go and read, because like we need to understand this stuff. It's very important.
All right, Alexei, and also one question from me. So when exactly would you recommend launching a token? Like some general guidelines? At which point in time?
At which point we start like making tokenomics or launching the token, because it's a different stuff.
No, I mean, no, I know, but I'm referring like particularly to a token, like to at least understand like generally whether you need it and whether you need to design a tokenomics model.
Well, design a tokenomics model. Well, there are like two options. First, you're like Web2 startup and want to introduce the token, then like anytime, yeah, when you want, you can do it. So you need some time. If you're like, it's a big service, so we need at least half a year to build the right tokenomics. If you're a small one, then like 1 month, 2 months, 3 months, and so on. So like, if you want to start in 3 months, and so probably you should start right now. If you have 1 year, then probably you can wait a little bit. But that doesn't mean that all the time you're like doing the tokenomic stuff. You think it over, you like consult, you get some information, you see different structures, then you put this in one document, and then you decide one day that you need this tokenomics. So like before, if the token is a vital part of your startup, you are building a protocol with a native token, just understand that like if it's a big startup and it's round A, then you're gonna need half a year. So like that's the point you should start. And like what's more important here is that token is a part of the product. So you then implement this information into the smart contracts. And imagine you created some smart contracts, and then you change the tokenomics, and you will have to change the smart contracts as well. And this is a big mistake of founders that like come to us. They tell that, okay, we have the product, please insert the tokenomics. But the problem is that the tokenomics can fully change the product itself. The smart contracts, the whole delivery can be different in this case. So this is a big problem.
Yeah. Okay. I mean, this is very important that you've just underlined. And I think especially for Web2 startups that want to pivot into Web3, like all this stuff sounds absolutely, uncommon and unfamiliar. So guys, you definitely need to dive deeper and to get very qualitative help from experts and consultants, because otherwise it just can jeopardize the entire future of your product. Okay, so I believe we have one more question, and indeed we do have some time for it. Okay, so we have one more. Alexei, what is your experience using dual token models?
Which models?
Dual.
Dual.
Yeah.
Well, we used it in several play to earn projects. Like I think for several types is okay. For example, you are making a launchpad and you need like separate tokens for the projects that you launch and your token, and also for gaming projects, because one token is for investors, another is for users. So have some experience. I don't know how deep it is, but my team is much more experienced in that. So together we bring pretty much knowledge about this dual models. I'm not a big fan of it, but I understand sometimes we need this. Especially when you have completely different audiences, completely different stakeholders for different tokens. Or sometimes you have like the slider case where you have stake Ethereum, yeah, staked something. This is basically like part of your product. And then another token is your own token, the native token, which has some governance and dividend like with utilities. So like I would say 30-40% probably is dual case.
30-40%. Okay. All right. So unless we have any more questions, Alexei, I would like to thank you very much for coming and joining us today. You laid a very strong foundation, I think, especially for the people who, were just starting to explore the space and thinking about a tokenomics model for their own startup or for any future affair that they're going to undertake in the market. So thank you again. We will continue next week for the members of XFounders community, diving deeper into a particular case of a startup. So guys, if you want to reach out to us to learn more details about what exactly we're offering in our community and for our pitch hour with investors and business angels, just find us on LinkedIn. I mean, you're already watching us there. So yeah, feel free to reach out to make an application through the website or just use direct messages. Thank you so much. I wish everyone a lovely evening and see you very soon.
Yeah, thank you very much and see you.
See you. Bye-bye.